So the first category of owner fringe benefit that exists is autos. We get a lot of clients that we have, or prospects that we have, forget about the fact that cars are definitely an allowable expense as a business owner. And one of the common questions that we get asked is, yeah, but I work out of the off, I work out of my house. Is it really going to be a tax deduction, for me? Well, guess what? Every time you leave the house, since your house was a home office, that's going to be a tax deduction. Yeah, but I don't really drive a lot. Well, guess what? Um, if you've got two cars, maybe one of them is a company car. So I think a lot of people, take this auto because the other one could be driven on the weekend, right? So a lot of people take this auto as hey, that's just, based on my attributes, maybe that's not for me. But you know what, when I think about this auto expense as an example, the guy that always comes to mind for me is my old neighbor Tom. He was a sales guy that worked in medical device sales, worked out of his home office, and always had a fabulous company car that the company was paying for. So for some reason, LabCorp decided that Tom having a car was an allowable expense. And LabCorp has got a lot of smart people working for him, a lot of smart tax people working for him. In fact, they used to be a tax client of my former employer, Ernst and Young. So with that in mind, if they thought it was a good idea, why wouldn't I think it's a good idea? So the bottom line in saying that is that I think, with autos, a lot of times, people either, read the internet and they read, something extremely conservative, in terms of a position like, oh, beware, or like they had a CPA that was a Dr. No CPA instead of a growth CPA, somebody that's looking for the yes. And they just ruled this out, as an item that could be available to them. When in reality, it's perfectly allowable, perfectly available. So why would you not be doing it? And then the question becomes, well, if I'm going to do it, how would I do it? And the how I would do it would either be, I'm going to expense mileage, I'm going to depreciate the car, or and the actual expenses like gas and everything else and the insurance, or alternatively, I'm just going to reimburse myself a car allowance, just like a, large company might give me, $500 or $1,000, a month for a car allowance. So what's kind of the upper limit of what would be allowable, kind of the actual expense of the car, maybe a couple grand, it could be a very allowable expense that when you start adding that up, multiply by the tax rate, it's like, well, wait a second. Now we're talking about 6 grand in my pocket, for taking this deduction on something that I was already paying for anyway. So that's the kind of thing where, to me, it starts to become worth it. So autos, again, it sounds silly, but commonly overlooked, especially when people are like, yeah, I need to keep my company. Let's say that I'm in a multi-partner environment. And it's like, well, we want to keep the company clean. Well, again, the way that you solve for that is you just agree to, a mutually beneficial amount that you're going to reimburse yourself for autos. That's what myself and my partner did when we started the accounting firm. Is we just said, hey, what's an allowable amount? A couple $1,000 a month. There you go. That's going to be our auto expense. If I'm going to drive, a Ford Pinto, and you're going to drive a nice brand new Porsche, doesn't matter. We're each getting $2,000. And that's not considered, it's a deduction for the company, not income to the recipient, because it's just a reimbursement for the personal use of their item. So that's item number one. Item number two is the home office. And the home office really has two elements that are available to you. Actually, three elements that are available to you. So the first thing with the home office that to me is just a layup, uh, is that the IRS allows for a safe harbor de minimis expense. So it's sort of like the goodwill receipt of just kidding with that, by the way. Of course, you actually donated stuff to Goodwill. It's like the Goodwill receipt of expenses where, hey, I believe the limitation is I think $1,200 a year. No questions asked. Just deduct that, and the IRS is going to be okay with it. Again, you multiply that times your tax rate. You're welcome. That's going to be, a couple $100, that you're putting in your pocket on a de minimis basis. The other option available to you is, you can look at the dedicated amount of home office space that you've got available to you, multiply that times the square footage, like of the house. Like, if I have a couple hundred, if I have a couple hundred square feet, that's what I'm going to take. And then I take that relative to the overall expenses associated with operating the house, whether that's the interest expense associated with my mortgage, utilities, blah, 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 blah. And then I'm also going to take, anything that's dedicated specifically for the space. So if I've got upgraded internet or whatever, I'm going to take that as well. Well, a lot of people, especially in the time of the pandemic, they're like, well, I'm working out of the house, I might as well make this thing look pretty nice. They forget about all the remodeling that they did. Whether it's, custom desk, custom cabinetry, they're really only using it for the purposes of it being a home office. You should take a deduction for that. So that's category number two. Category number three is, we get asked by clients, sometimes that are really watching the TikTok, so they got the TikTok of, well, this is the little thing that people have never heard of, the Augusta rule. So the Augusta rule was created by the good people of Georgia as part of a lobbying effort, because they wanted the ability to rent out their house to people that are using the masters, but not have to claim the income, as long as the rental was somewhat de minimis for a length of time. So, point in saying all that is that you have the ability to rent your house from yourself for a specific business purpose for a period of time. And I'm gonna double that up with a vacation, because they are a little bit mutually exclusive. But the other option that I've got is to use the Augusta rule and just say, hey, I've got a home office, but once a quarter, I'm going to use it for an annual planning retreat, rent it for myself, and pay myself what the going rate is for that house. Again, expense for the business, and not income for the recipient based on this rule. So then the third category is the executive assistant. You got to be a little bit careful with this one, because what do I mean by the executive assistant? By the executive assistant, I mean family members and people that might also possibly, help out with the kids from time to time. So this would be a person that, hey, could you help me out, to keep my life in order, go do this, that, or the other, help me book a meeting, help me book some travel, get the kids to and from, whatever. So, some people might call this a nanny. I would not call them a nanny. I would call them an executive assistant. I'm just saying, because honestly, if you look at their duties, a lot of times, the kids are just a little piece of it. A lot of times it really is, to help me live my life as a CEO. So that's another one that people overlook is domestic help that really isn't domestic help, or at least can I carve out a portion of what they do to make a deduction for the executive assistant type duties, if that's an attribute that I have in my arsenal. And again, point in saying all this about, hey, after the end of the year, these are opportunities for you. This is, once you know about them, you obviously should do them, during the course of the year. But in this particular instance, the point of this presentation, again, is that a lot of people have these things and didn't even know they were deductions. So therefore, now that I know and already spent the money, why wouldn't I go back, and deduct them? So the third thing, or sorry, the fourth thing is the vacation rental. And by vacation rental, I mean the place that you're renting on VRBO or Airbnb, or you just, rent out on the side to people that otherwise you have used as a corporate retreat. So you've opened it up to employees, you've opened it up for customers, you've let prospects stay there from time to time, or close associates, but you've never charged them because hey, I already got it. Why would I charge you? Well, you can take a deduction for that in your business. The catch on this one, though, is I do actually have to claim it as income if I'm already claiming rental income for this property. But the thing, unless it's less than 14 days of rental time. But if I assume that I'm over 14 days of rental time, so it really is an active rental. You know, I can rent it from myself too. Just the same as anybody else might rent it from myself. The nice thing about that, as a business deduction, is that in a lot of cases, um, a vacation rental, maybe doesn't break even on cash flow. I know for a lot of people, their vacation rental, it's like, well, if I was going to rent a place anyway, that's about the same amount as I'm paying as a mortgage. Why not get a tax deduction? If you can get a tax deduction for the number of days that you use your own vacation place as a rental from yourself. It's also a great way that, hey, if you were looking, if you're trying to get a vacation rental idea that you were also going to use for some personal use over the goal line, figuring out how to make a tax deduction for it is a fabulous opportunity to get that idea over the goal line. And then the last category is the vacation. Well, I mean, vacations aren't deductible, Adam. Are you insane? No, they're not. But if you're like most business owners, especially if the spouse is in the business or you travel with your partner, or key employees that you're going with, chances are you're talking about business, at some point. So is it not the case that perhaps that vacation also could be pulling double duty as your annual meeting? So, or your quarterly planning retreat, so at least an element of the vacation is deductible. So the general rules around, you know, hey, can I deduct a vacation or not? The answer to that is no. But, can I deduct travel expenses where there is a business purpose, but it also doubles as a vacation? The answer to that is yes. I mean, if you Google that, you'll actually get some guidance straight from the IRS. It basically says, hey, what's deductible? What's deductible are the elements that were associated with the meeting itself. So like if I had a day, the day in the hotel would be associated with the deduction. At the same time, everybody that's involved in the business. So if I'm paying, me, spouse, and kids, I mean, we're all involved in the business. Our travel is potentially deductible in the business from that standpoint as well. So, once you kind of flag and identify all these, now that your minds are opened up, then you have the opportunity to go back and just, reimburse yourself, which the way that you do this gets into wonky speak, but you basically would say, let me, either write a check back to myself and record the expense, or alternatively, I book a shareholder loan or a partner loan, meaning that I loan the company money or I made a capital contribution in exchange for these expenses that I'm now deducting. So now as you're beating your head on the table saying, well, that's really great. I wish I would have known about these years ago. Thank you very much, Adam. You're welcome. Can you go backwards? Sure. Every year beyond 1 year, you're adding an element of a little bit of risk potentially to the equation. But at the same time, the statute of limitations for the IRS, assuming you did not commit fraud, and I would not advise anybody to commit fraud, but assuming that you do not commit fraud, is 3 years. So with that in mind, why wouldn't I consider an expense reimbursement for up to 3 years? The worst, kind of your worst case scenario is they reject it because you did it in 1 year, but they allow it and just make you go back and amend the old years. Either way, I'm going to get the deduction. Like I've never had a scenario where this was rejected out of hand. And by the way, for the person that is now thinking to themselves, well, that's great, Adam, and that sounds pretty risky. I mean, what do you know about this? We at BGW, knock on wood, we have a handful of audits that our clients go through every single year. And we obviously push our clients as much as possible to do as aggressive owner fringe benefits they feel comfortable with. We've never had these overturned. So again, knock on wood, these are all items that have passed the audit smell test before. So again, before I move on to the next topic, if you guys have any questions, hit me up in the chat, and I'll be happy to answer them. Otherwise, I'm going to keep on trucking here. All right. So the next category of items that are available is the area of retirement accruals. So what I mean by retirement accruals is, hey, I'm thinking about retire. I'm thinking about contributing to a retirement account. Like end of the year was pretty good. Hey, what else can I do? Well, as an owner of a company, you can still contribute into a retirement account even after the year's already passed, as long as you meet a couple set of facts. So let me back up and answer a couple questions. So from Rosemary, I said can you take a portion of the vacation if you're still working while on the vacation? Not a quarterly meeting, but you're working, maybe finishing a report or conducting conference calls. I probably would call that a corporate wellness retreat, Rosemary. So everybody needs a little bit of disconnect time so they can do some creative and thinking brainstorming. So even if it wasn't formalized, I probably would still say, hey, I needed to do that to get away from a brainstorming session, and some stuff came up. Because otherwise, the case that you're going to run is, yeah, you were just remote working from a fun place. So I would call it something different. But otherwise, I would say yes. So for the auto, if we take the Fed mileage rate reimbursement, can I take a car allowance as well for a one owner firm? Yeah. So on that one, you're going to take one or the other. And what I'd recommend is, you kind of look at, well, what do I drive in the year? Let's say it's 20,000 miles, times the mileage reimbursement rate is, I think, about 60 cents a mile right now. So you got $12,000 a year. I kind of would compare that to roughly what are my actual costs. And if my actual costs are $2,000 a month or $24,000 a year, I'm going to take the $24,000 a year. If my actual costs are more like, 5 or 6 grand a year, because I drive an old car, and it gets great gas mileage and the insurance is real cheap because I'm a safe driver, I'm going to say I'm taking, I'm going to set it at, 12 or 13 grand, because it corresponds to the mileage rate. But you can't, what you can't do is you can't double dip. So once you got a method, just stick with the one method. But great question that you have there. But back on to the retirement accruals. So with the retirement accruals, what we typically, you got 3 categories that you can do. One is the SEP, which is a Simplified Employee Pension Plan, which is just another fancy name for a retirement account. The next is a 401k. And then you've got the sexy Cadillac called the Defined Benefit or Cash Balance Plan. The point in saying all this is that if this is something that I want to consider doing as a business owner, as long as for the set plan, that's something that is available to me after the end of the year to even set up. So even if I don't have one, I can still get it set up after the end of the year. And I can contribute up to 25% of my income into the SEP, and the contribution date is the later of the extended due date, like the extended due date of the tax return. Sorry, the earlier of the extended due date of the tax return, or when I file the return. So conceivably, if I'm a business, I could take a deduction in April of 2025 for the 2024 year, but not actually have to fund that cash into the retirement account, assuming I extended my tax return until September of 2025. So I've got a 2024 tax deduction that I'm actually not putting the cash into the retirement account until September of 2025. So this is, assuming that I don't care about market timing or any growth or anything like that, this is a fabulous little cash flow management tool to defer taxes. And again, the SEP can be set up, after the end of the year. I believe as long as it's set up by the original due date of the tax return, which is going to be March 15th. I don't know if that off the top of my head, but I'm pretty sure that's right. For the 401k plan and the defined benefit cash balance plan, those are a little bit more complicated in the sense that they need to have been, for the most part, I think simple as you can set up after the fact. But for the most part, if you got kind of a full-blown employee 401k plan, those need to be set up before the end of the year because you need to give notice periods to everybody associated with there being a plan. But otherwise, that's one where, hey, under the right circumstances, I can get up to 60 grand a year into a 401k plan. And again, as the owner, my money is technically not due until September. The same as with the SEP. And then if I'm feeling really crazy, I can go all the way into a defined benefit cash balance plan, which is going to be a couple $100,000 that I could be deferring into a retirement account. Again, not due until September of the subsequent year if I've got an extended tax return. That's going to work out best for businesses that have a pretty high, pretty high cash flow, meaning like they're feeling, they feel pretty confident in their cash flow because you have to do, you've got to meet a commitment over a period of years. So we got a couple questions that we have here. Another one from Rosemary. Good to hear from you again, Rosemary. We let employees work remotely 2 days a week. Are employees able to claim working at home as a deduction? So from that perspective, yes and no. So with that one, Rosemary, they can't claim the deduction because, the IRS, as part of the Tax Cuts and Jobs Act, they got rid of unreimbursed business expenses as an itemized deduction. So, thank you. So there were a lot of great things in the 2017 Tax Cuts and Jobs Act that we really liked. One of them that we didn't like is they overhauled itemized deductions, and they got rid of some stuff, that people were used to before. So if you're cool with it as the employer, what you can do instead is you can just reimburse them. So, for example, if you said, hey, take BGW as an example, as part of our tech stack, and we allow people to work from home, as part of our tech stack, you got to have pretty darn good internet that requires you to perhaps get a better service than you were going to have had you not, work from home. So if I want, option A, I could be, well, work out of the office, but option B is, I could just reimburse the employees for the use of their upgraded internet service, which kind of get, maybe, add on a couple bucks, but that kind of gets you to reimbursement of the home office levels for people if that's a benefit that you want to provide to your employees. Megan, I've read a cash balance plan does not require a concurrent 401k profit sharing plan for the IRS. Why is it recommended to do both? What are the risks of doing a cash balance without a 401k? Any experience with this? Good question, Megan. So a couple things on that one. So with the any risks of doing a cash balance plan without the 401k plan from the IRS's perspective, no. But the risk is going to be more around the commitment to the funding level. So when you enter into a cash balance plan, what you're basically doing, it's kind of like an old school pension plan, in the way that it behaves. It's basically saying that in the future, when I retire, I want $2 million. I'm 50 years old. If I want to have $2 million when I retire, how much do I need to contribute at a projected growth rate at my current age to have that $2 million accumulated, upon retirement? So there's like a set funding level. If you end up, that's great if you got extremely predictable cash flow. But if you don't have extremely predictable cash flow, then you start getting into um, hiccups, and you've got makeup years, or you got to break the contract, pay some penalties, all sorts of stuff that has to happen. So the reason that's reason A to consider having the 401k plan as well, because the 401k plan, you got some more flexibility in terms of at least turning off that component of it if you need to from a cash flow perspective. That's reason number one. Reason number two is that if you've got employees, part of the deal is you're going to have to do some matching contributions for them. So the nice thing about that is that, part of those matching contributions, how you can arrive at some of the calculations is that, hey, you're only going to match for people that are actually participating in the 401k at the max amount in the first place. So it's also a way to control for the employee match so that you've got, a little bit more legal discrimination over who you're giving money to. So you're only rewarding people that are also contributing, because in a lot of cases, there's going to be a limited amount that you're going to need to put in for the rank and file employees on the defined benefit cash balance plan too, if you're kind of maxing at the employee level. So Doug, thanks for the question. What's the best way to give a large bonus to a key employee without employee losing so much in taxes? You already know the answer to this, Doug. It would be to take all the owner fringe benefits that were a couple slides back and just come up with a reimbursement package. So, if you think about it, if I can come up with $20,000, $30,000 in owner fringe benefits that I can deduct for myself, isn't it equally plausible that those could be perks that I give to employees, whether it's an auto allowance, cell phone reimbursement for the home internet. Hey, we want you to have a computer, here is one. Educational expenses I'm going to reimburse you for. I mean, you can pretty quickly get to, tens of thousands of dollars before you get there. So Megan, do employers pay FICA on auto allowance? You work for the IRS. That seems like a technically trick question. The answer to that is no, in air quotes, because it's just a reimbursement for the use of their auto. So it never actually even hits their paycheck, with the lone exception that you do find some people will impute a personal use auto on the personal use of an auto on a paycheck. I mean, the way that we typically do it is we just set the reimbursement at what the business use really is, so that we're not having to mess with things, meaning mess with it running through payroll. So, for example, when would you have a personal use auto, that you would need to impute? If I was, paying for 100% of the car for my single traveling salesperson that I knew for a fact that was his only car, it's kind of hard for me to argue that he's not using it on the weekend. So the weekend amount, probably is personal use. However, same dude's got a second car. I don't know, like he's only using my car, during the week, and I got my sign on it. So that's where the nuances fit into place. Mr. Grabowski, I already have a loss for the year. Should I keep piling on, so to speak, meaning keep adding and the loss will be greater? Nobody gives you a gold medal for not deducting enough. So my answer to that would be, yes. I haven't checked to see if we've got any bankers on the line. Hopefully we do not. But the only reason that you might consider not piling on the loss would be, hey, I'm trying to refinance the house and that's going to look like poo. I might want to hang on to that, but that's about it. So Carrie's got a question. Is it more advantageous to declare dividends in an S corporation in the current calendar year, record them as a note payable to shareholders in the same calendar year, then pay the note payable and interest in the following calendar year? So the reason that I might want to do that, so you could do that. The reason that I might want to consider doing that in a calendar year is less so around, um, you know, it's going to be less so from a tax perspective with one exception. The reason that I would consider doing that in a calendar year, even though they're paid in a subsequent year, would be, first off, if there's going to be an ownership change, I want to establish like what who was supposed to get this loot. So for example, if I'm 100% owner and then I'm going to bring on a 25% owner and I've got a big stock full of cash and I'm planning on doing a dividend, but I'm not going to do it in the next year, that's technically 100% of my money that I want to share with the new 25% owner in the subsequent year. That would be one reason that I would go ahead and declare the dividend in S corporation, record it, and book it, and then pay it out the next year. The other reason that I would consider doing it is that um, some states, as part of their tax regime, tax your book equity. So if you've got cash and retained earnings, which you would if you hadn't recorded a dividend, then it could be that you're creating, this is the way North Carolina used to do its taxes, by the way. It could be that you're creating taxes where if you simply move that to be a shareholder loan payable, even though you haven't distributed the cash, all of a sudden you've avoided some of the state level, corporate right of use type taxes. So can I do it? So hopefully that answers your question, Carrie. WJ, can you do a quick review of the self loan reimbursement? Sure. So the way again that works is that you're going to, I go back, it's 2025, and I'm like, crap, I just heard this webinar. I need to go back and go through my bank statements and kind of figure out what did I have, where, and take a deduction for it. What I'm going to do, again, this gets in a little bit of a wonky accounting space, but I'm either going to tell my bookkeeper, if I'm the bookkeeper, I'm going to record a debit on the income statement for the expenses that I had. And then I'm going to record a credit for now the company owes money to me, which is a shareholder loan. So that's the technical mechanics of how you book it. And then you'd book the date as of 12/31, of 24, when you actually incurred the expenses. So hope that helps. All right. Moving on from retirement accruals. It's funny. I do these all the time on the weekly webinar, but I was actually nervous before this one because I'm like, I don't even know if I've got an hour's worth of material, and it's like already 2:10. So thank you again for all the questions, everybody. Moving on from retirement accruals and into accounting method changes. So if y'all want to tune out now, I'm just kidding with that. You're gonna make me feel bad if you tune out. We're gonna get into the wonky stuff. So even if you haven't, it's at the end of the year, you've already spent the money, you've already done everything, you're just running your business like you normally would. There's still stuff that you can do that doesn't even require any cash. And I'm going to go in reverse order here because that's kind of simplest to most complicated. The first thing that I can do is if I bought a piece of real estate, the normal method of depreciating real estate, if it's commercial property, which remember, vacation rentals are technically commercial property, is that it's depreciable over 37.5 years. Well, based on the tax code, so that sucks because chances are I'm not going to own the building for 37.5 years. But based on the a famous tax court case involving a hospital, now hospitals are not for profit, so I guess it's a for-profit hospital. But anyway, based on a famous tax court case, what the IRS allowed is you were able to carve up elements of that building into faster lived subcomponents. So, for example, the carpet obviously is not going to, I mean, unless you got a basement with shabby carpet, the carpet is not going to last 37 and a half years. So that's going to qualify for faster depreciation. The HVAC is not going to last 37.5 years. That's going to qualify for faster depreciation. So, the punchline to all this is that when you add up all the subcomponents that the IRS allows you to deduct at faster than 37.5 years, what you find is that oftentimes anywhere between 25 and 35% of a building qualifies for accelerated methods of depreciation. So I already bought the building, it's already in service. I can accelerate some of the depreciation on it, even if it's after the end of the year. The nice thing about this one is that let's say that you're like, well, again, that's great, Adam, but I bought the building 2 years ago. You can catch it up. Like you could, this is another one where you can go back in time and say, whoopsie, made a mistake. I'm going to go get it caught up. So oftentimes, we find that we have clients or new clients to us, because we would never screw this up. They come on board that, had property that could have qualified for accelerated depreciation. Whatever reason it wasn't taken, we're going to do a catch up. So that's a nice one. The second thing that you can always do after the fact is inventory. And with inventory, you really have two items that are associated with accounting method changes. One is, to the extent that you've got, obsolete inventory, and, technically you're supposed to take this off the shelf and put it aside, for scrap. But if you've got obsolete inventory, which is, that island of misfit toys you've been hanging on to that you're not going to sell, you could always, just write it off, as long as you're planning on, scrapping it, donating it, whatever you're going to do, you can always write it off. That's a simple way. The accounting method change that's available to you really comes in two flavors that are really related. One flavor is that if I'm if I'm a large company and I've been allocating some element of overhead to my inventory, meaning like, hey, I make it, it moves through raw materials and finished goods, and I'm going to allocate some overhead back to it, to before it gets to finished goods inventory, I can expense all that for tax purposes. So, if that was like 2-3% of inventory costs, which this mostly applies to large companies, all of a sudden, like I've got a pretty large write-off, that I could take. The other thing that's available to you too is that same scenario. If I have labor that's built into that inventory cost, as long as I'm below, round numbers, $27 million in gross receipts, I can write that off, the labor component. Then lastly, this is actually one of my favorite ones, is that we have a lot of clients that, for correct reasons, they've got big stuff, like a big, new furnace, that's in inventory. Let's say they're an HVAC installer, but at the same time, they've got a bunch of nuts and bolts that are really repair parts. Well, you can also declare the de minimis level of inventory, call it, an individual SKU of, greater than or less than $100. We're just going to go ahead and expense because it's really a repair part. So you can also write those off as well, which again, if you just add up all of your de minimis inventory, it can be, again, pretty substantial from a write-off perspective. Next area to look at is, converting from accrual to cash. So this is one that caught a lot of people by surprise. So, if I'm an accrual basis taxpayer, obviously, I pay tax on an accounting basis, meaning like, regardless of when I collect money or I pay out money, I'm going to go ahead and I'll go back to your question here in a second, Megan. If I'm an accrual-based taxpayer, I'm declaring, income based on when I invoiced, like earned it, and accrued the expense. Cash basis, it's the opposite. It's as I receive the cash and when I pay the cash. Well, a lot of people didn't realize, as part of the Tax Cuts and Jobs Act, that companies that didn't think they qualified because they'd reached the dollar limit threshold, which used to be $10 million. Well, that dollar limit threshold was raised to $27 million. And it's measurable on a trailing 3-year basis. So, I mean, once you trip it, you've still got a look back period before you got to pick it up. And even if you trip the look back period and you're over the threshold, then all of a sudden, next thing you know, it's like you got 5 years to pick it up. So you can effectively defer a good slug of taxes on the conversion, because what you're basically getting the benefit of is I've already paid taxes on my receivables that I had at the end of the year. I can now exclude all that from my income. That first year, it's a big deal. And you're going to get several years before you actually have to pick it up. Again, if you trip it. So it is a big deal. Some people, it's going to make sense to actually reverse the other way and become an accrual basis taxpayer, especially if I've got a pretty significant deferred revenue component, like a software as a service company that's getting a big deposit, or if they've got big maintenance contracts. So Megan, rolling back, clarify writing off labor-related inventory. Didn't quite understand that. So in a typical manufacturing environment, you've got raw materials, which that's the crap that I bought, and then I do stuff to it to create a finished good that involves labor. In most organizations, if I look at the value of a finished good, anywhere between 20 and 50% of the value associated with that finished good is direct labor expense associated with it. Well, if I'm below $27 million in gross receipts, I can deduct that labor instead of capitalizing it as inventory. So that's what the labor piece is there, Megan. And then the last one that's available to you is, a lot of people, think that all is lost, is after the year, can I still be an S corporation? The answer to that is yes. I mean, as long as you file an S election by the extended due date of the tax return, or sorry, the original due date of the tax return, which is March 15th, for the preceding year, the IRS grants automatic approval to that. So you get automatic approval on it. So if the circumstances are right, it's a great way to save money. A lot of people are like, but I didn't take a paycheck. What am I going to do? There's ways around that, to be able to fix things after the fact and still get some Social Security taxes paid in. So great questions, everybody. I appreciate it. So in the interest of time, I mean, I could talk forever about the stuff. We're going to go and keep on moving to the last topic, which, this one's going to apply more to accrual basis taxpayers only. But again, it's a common problem that we have. So bonuses, as long as bonuses are paid within 90 days of the calendar year, I can go ahead and deduct them from the preceding year. So December 31st, I know I'm going to pay my salespeople a bonus. I know that bonus is going to be paid, sometime before March. Even though it's not going to show up on their W-2, I can take a deduction for it. Employee bonuses that I know that I'm going to pay, I can take a deduction for it. Here's one of my favorite ones. If I've acquired a company, now that old owner is on my payroll, and part of what I'm paying him is a stay bonus that is now in his or her W-2, and I know they're going to hit it, I can accrue it and take a deduction for it before I actually pay it to the person. It's a great way to get a full year of basically a tax holiday for something that I'm literally going to pay in 30 to 90 days. So that's one item. Another one that we see all the time that catches people is, other expenses, if they're recurring items or anticipated. So this would be pretty common in the construction industry where I've got subcontractors. And, I like to pay my subs timely, but at the same time, they're super crappy at invoicing me timely. So, most of our clients, that are construction clients have jobs that are open for a period of time, primarily because they know they're going to have crap that comes in, that needs to be allocated back to a job, but somebody was just slow in sending them a bill. Well, all that stuff could be accrued. If you kind of know about what it's going to be, as long as it's paid, within 90 days of the subsequent calendar year. Another one that's, famous would be an accounting bill or a legal bill. We're pretty good about invoicing. But those other accounting firms down the street, maybe not so much, and definitely not law firms. Like everybody loves the, do 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 do, and then all of a sudden I get a $50,000 legal bill from like 6 months ago. Those are all items where I got the bill. It's like oh geez, this actually was for last year. I can go and accrue that. If I kind of know if I know that it's coming, and then take the deduction in the year that I really incurred it, even though I haven't technically gotten the bill yet, even though if I'm pretty sure I know, about what the amount is going to be. So that's another fabulous one that's available. So that is our magic bag of tricks. I'll go ahead and give you guys about 5 minutes early to answer any questions that you guys might have. But this is another funny quote that I found. I heard from Toastmasters that I'm supposed to close these things with a joke. But this is kind of the way that I feel. So let me get this straight. I'm paying taxes on my wages. Then I'm paying sales tax to spend my own money. Then I'm paying income tax, when I invest it and then harvest it as a capital gain that was already taxed. And then when I die, my kids pay the death tax on my money that was already taxed. I mean, I guess I could probably make a case that I'm actually taxed more than I really made when this is all said and done. But it is kind of a funny way to think about how all this stuff stacks on top of each other. They didn't include the business owner equivalent of this, which is property tax. That's one of my personal favorites, which is, you know, I used, I used my money and paid sales tax on it, and then I have to pay property taxes for the right to use it to earn income that I'm then subsequently going to pay you taxes on. So that's another one that really drives me a little bit crazy that we have to pay that. But anyway, I hope this helped. It is 2:24, so I'm going to go ahead and open it up to see if we've got any last questions that you guys might have before we close this off. All right, Megan, yes, you can get a copy of the slides. We're also going to send out a link to the recording on this, assuming that we got this right. Jamie, I might have started a little bit late, so we are going to go with Colossal Whiff on our first LinkedIn Live event. But I appreciate you guys all being here. We're going to keep on doing these throughout the course of the year, so we'll keep on doing doing invites out. Thank you, Carrie. Thank you, Mr. Grabowski. Thank you, Megan. I don't technically call him Mr. Grabowski. It's really Tom, but I thought that he'd like that. Show him a little respect. But thank you guys. We really appreciate you. For everybody that's a client, obviously we appreciate the business and we appreciate your loyalty, and happy to do this. Thank you very much, guys.